Okay, so the last couple of things that we need to talk about in Chapter 5, deductible casualty and theft losses. So what's a casualty? I mean, so when some event occurs that is sudden, unexpected, and unusual in nature. Most people think of casualty events, so something where you had to, maybe your home was destroyed because of some natural disaster, or because of a fire or an earthquake, something of that nature. Now, it can get a little bit weird because some of those things, even though they may be sudden and they may be unexpected, you weren't expecting to have a hurricane hit you, they may not be unusual in nature. So, for example, if you live in Florida, it's not unusual for hurricanes to hit, right? In practice, though, the IRS really doesn't deny people a deduction for a casualty loss for something like a hurricane, even though it may be unusual in nature. But the difference is that common household accidents, so breaking furniture, damage caused by a pet, these are not considered to be casualties, even though you may incur some loss because of them. It doesn't count as a casualty loss. So these losses are only deductible, and there's a calculation that goes along with figuring out how much of any potential loss actually is deductible. But first, you have to determine if they even count as a casualty loss under the tax code. In order to be a deductible casualty loss, you have to be, it's only deductible if that loss is attributed to a federally declared disaster. So in addition to, so if you have a fire at your house, but it was caused by a gas leak that occurred in the neighborhood, there's no federally declared disaster associated with that. And so therefore, even if you suffered, even if it was sudden, expected, and unusual in nature, it's not classified as a casualty loss because there was no federally declared disaster in that area. Now, if the fire occurred as a result of a gas leak because of a hurricane that hit, and it is part now of a federally declared disaster area, well, now it does count. It would be included as a casualty that would potentially be eligible for a deductible loss as an itemized deduction. So what they've got, let's look at this example. We've got damage to walls and flooring from the progressive deterioration of a roof is a non-deductible casualty loss. The event was not sudden, but gradual and progressive. Likewise, when a patio porch collapses as a result of excessive dry rot, the casualty loss would also be disallowed. But the first test that you have to pass is it a result of being in a federally declared disaster? So that's the first and probably one of the bigger hurdles to get over before you can determine whether or not it would be included as a casualty loss. So, and this kind of goes through the fact that, hurricanes are not necessarily unusual in nature in certain geographic areas, and so it might not technically fall under that category. However, they're not going to deny victims of hurricanes who suffer casualty losses that deduction as long as they're in a federally declared disaster. So the magnitude of the casualty, not the primary factor in deciding whether it's a casualty. The key factor is that presidential declaration of a federally declared disaster area. So if the governor declares a disaster, it does not count. So I know we've had some disaster areas declared just by the governor in Iowa, but they aren't federally declared disasters, and so whatever disaster it was that occurred would not be included. So this is one of the reasons why they want to get those federally declared disaster areas. Also, it frees up money for people to then draw down from to repair any damage. So that's the first big hurdle to get over is it a federally declared disaster area? The next hurdles to get over are you've got to calculate, well, how much is the amount of the casualty? And whether or not it actually amounts to much of anything as far as a deduction goes. So in order to determine it, this is the calculation. So you take the fair market value immediately before the casualty. So what was it worth before the hurricane? You've got a house that's worth $300,000 before the hurricane hits. Then you subtract what the fair market value is immediately after the casualty. So this is determining how much damage was actually done to the value of the property. So let's say there was $100,000 of damage. So the fair market value immediately after the casualty is $200,000. So if we take, again, fair market value before, say it was $300,000. Fair market value after, $200,000. Subtract that. So this gets us to our decline in fair market value. $100,000. Now we're not done yet. That's not the amount of casualty loss that we can take advantage of. So let's see. Then we have to compare it to our adjusted basis of the property. Generally speaking, that's what we paid for it. So if we paid, let's say we paid, our basis is $150,000. So this is part B, this is part A. Select the smaller of A or B. All right, well, the smaller of those two is A. We have to subtract any insurance payment that we received. Okay, so let's just say we got $80,000 of insurance. This is our casualty loss. $20,000. Now we've got to subtract $100 per event. So that's per occurrence. So we'll subtract $100. I don't know what the $100 is. It seems pretty piddly to me, but $19,900 is what we have left. That's our eligible loss. Then we have to take our AGI. Again, another case where we need that AGI. Let's just say our AGI is $100,000. We have to multiply that by 10%. So $10,000. We have to subtract that from our eligible loss. So 10% of AGI. So 9,990. Whoops, 9,900 is our deductible loss. In reality, a lot of times the insurance payment is probably going to cover all of that. So essentially, you're not going to get any deduction. But if you didn't have insurance, which is a terrible thing to happen, you're still going to be limited to that. You're still going to have to subtract 10% of your AGI. So it's kind of like the medical expense deduction, but it's 10% instead of 7.5%. Remember, it was always the amount that's deductible was 7.5% the amount that was over 7.5% of AGI when we talked about medical expenses. Now it's the amount that is over 10% of AGI that is deductible for our casualty loss. So taxpayer can deduct the uninsured loss. This is essentially what our uninsured loss is, or out-of-pocket loss in a federally, again, this has to be a federally declared disaster area, subject to certain limits. Uninsured loss would be the loss due to the casualty or theft minus any insurance recovery. So there's our casualty loss, but then we're going to further be limited to those amounts. So this is just going through the same calculation we just did. So what they mean by adjusted basis, the original cost or the basis of the asset minus any depreciation or amortization, plus the cost of any capital improvements. So, for example, with a personal house, we don't depreciate personal houses. We don't depreciate any personal real estate or personal property, personal use property. Like this maybe we paid $100,000 for it, but then we had done a $50,000 improvement. That would be our adjusted basis. That's how we would get to that $150,000 adjusted basis. So here, they've got an example, Tracy and Barbara. They bought a personal residence in 1998 for $95,000. In March 2024, the appraised value of the house was $500,000. So that went up quite a bit in value. Most of their belongings were destroyed by a wildfire that consumed hundreds of acres in Southern California. I think we've heard this story before. Palisades Fire. I'm assuming it was a presidentially declared disaster area. The area was designated by the president as a federally declared disaster area. The amount of the casualty loss for the house is $95,000, though. That's the amount of their loss, is $95,000, because that's the adjusted basis. That's what they paid for it. So remember, we've got to choose between that decline in fair market value or the basis. We're going to take whichever is less. So if they bought that house a long time ago and they didn't pay that much for it, at least in today's dollars, that's going to be the amount that we take. So $95,000 minus any insurance reimbursement that they receive. Chances are, because the fair market value of that house was $500,000, they may have gotten a check for $500,000. That means they're subtracting that from the $95,000 loss. They don't get anything here. So $95,000 or the decrease in the fair market value of $500,000 because they received no insurance. In this case, they received no insurance reimbursement for the damage. The losses for the personal belongings would be calculated on an item-by-item basis. Okay, what? So the casualty loss in this case would be $95,000. In their example, there was no insurance payment, so that casualty loss would be that $95,000, but they don't get the full amount. And again, this is just a deduction, so it reduces their taxable income for the year. So they're just saving taxes. They're not actually getting $95,000 because they didn't have the insurance for it. Here's another example. Akeem purchased an automobile, non-business purposes, for $25,000. April 2024, he had an accident with another automobile. So he doesn't get to take this anyway. We don't even need to go through this because this has nothing to do with a federally declared disaster area, right? Although, if he happened to an accident because he was in the middle of a hurricane that was then a federally declared disaster area, he could probably take this as a casualty loss deduction. So you report it on the tax return in the tax year that the loss took place. Casualty losses may be deducted in different tax years depending on the circumstances. So a theft loss that occurred in a federally declared disaster area would be deducted in the tax year in which the theft was discovered rather than when the year of the theft. So think about when would this maybe occur? Like if you have, say there were some riots, not that that would ever happen, but there are some riots and there's looting that goes along with those riots. The riots cause damage that then the area is declared a federally declared, presidentially declared disaster area, and then looting occurs. That would be theft, right? It's not because of the actual event, but as a result of the event, the looting occurs. That would be the theft that's associated with it. But you don't notice that something was stolen until later, maybe the next year, when you're looking for it and you realize, oh my gosh, that was stolen as well. So in that case, when you discover it, that's when you get the actual deduction for it. So here's Stefan collects rare coins, had his collection appraised in October 2023. In March 2024, he was reviewing his collection after returning to his home when he was evacuated from a federally declared disaster area. He noted that 2 extremely rare coins had been stolen. He didn't notice it, though, until the following year. Stefan then deducts the loss in 2024, not in 2023 when the theft happened, but when he discovered the theft in 2024. Taxpayers have to subtract any insurance reimbursement in the determination of their loss. So this insurance payment, even when the insurance reimbursement has not yet been received, if there's a reasonable prospect of recovery. So you have the loss in 2023 or in 2024, October, you submit for insurance and you're pretty sure you're going to get it, but you haven't received it until 2020, the next year, you still have to subtract that insurance from the amount of the loss. So what you think you're going to get. So it should be, the casualty loss should be adjusted for the anticipated recovery. Should the loss be deducted and recovery occur in the subsequent year, taxpayer must include, so if you didn't know that you were going to get it, say you thought that the insurance was going to reject you, you went through this whole thing, you didn't get the insurance, so you had a $100,000 loss, and after going through all of that, you got this deductible loss, but then it turns out that insurance does pay. Now you've got to include that insurance payment as taxable income in the year that you receive it. So if you took the deduction, but it turns out that you got the insurance reimbursement in the next year you're going to have to include that as taxable income because you got a deduction for it when you shouldn't have. So again, it's evening that out for the timing. Individuals are required to file an insurance claim if they're in a federally declared disaster area. If they're insured, if they have insurance, they have to file a claim for it. You can't just in order to get the deduction, you can't just say, oh, well, I'm not going to file a claim for insurance reimbursement, and therefore I'm going to increase my deduction. It doesn't work like that. Let's see. President of the United States declares taxpayer can elect to deduct the casualty loss against the preceding year's taxable income. So if there is a major event, and it's a national disaster area, taxpayer can elect to deduct the casualty loss against the preceding year's taxable income. So if there's a major disaster, they can get immediate assistance by then filing an amended tax return. They don't have to wait until the end of the tax year to file that return and then get the relief. So that's what that allows it. So when they file an amended return, then they get that money back a lot quicker. Let's see. Limitations, so that $100 per casualty, not per item of property. So it's per casualty, so per event. So whatever the natural, if you're unlucky enough to have 2 natural disasters occur during the year and you have 2 losses, that $100 would apply to each of those events. So you would have $100, you'd have to subtract the $100 for the first natural disaster and the $100 for the second natural disaster as well. And then the other limitation, of course, is that 10% of AGI, which we just went through that calculation, so I'm not going to go through that again. Let's see. Jose and Maria. No, I'm not going to go through this because this is part of the shoebox, unless well, here's it does go through the calculation, so let's take a look. They had a loss, presidentially declared disaster area, furniture, cost or basis here, what they paid for it, and their personal residence, and then the decrease in the fair market value. So the fair market value before they did this calculation. We don't really know what it was before or after, but the decline in fair market value here, they have in total, do they have this? Yeah. Okay. Oh, they've got all of that there, but we can combine these. So the basis here, we don't know what this is, doesn't matter. Decline in fair market value of all of these items, so 55, 58, 67.5. That's the decrease in fair market value. The original basis of all of these items, let's see, 18, 25, 45, 43.5. Or 243.5, sorry. Doesn't look like a 2. So 243.5, and insurance proceeds were 50,000, which we will put here. So we're going to take the smaller of A or B, right? 50, did I get that right? 55, 68, yeah. So the smaller is 67,500, that amount. Compare those two amounts, take the smaller of those, subtract the 50,000, and so 500, 17,500 minus our $100, so 17,400. And then their AGI, did they give it to us? 110.48 times 10%. So 11005. So we'll subtract that 10% of the AGI. And they've done the math for us here. 63.95 is the amount of their deductible loss that they can take. So, what else? So, Ben suffered a $40,000 casualty loss in a federally declared disaster area September 2024, assuming that she had an AGI of 110,000 in 2023 and 200,000 in 2024. What is her best route? Well, she can go back and amend. She can claim it for 2023. They do allow that, and she'll get a greater deduction in 2023 because her AGI was lower, quite a bit lower. So, and she can go ahead and amend her 2023 tax return and get that refund immediately to help her right now with that. So, and this would be the calculation. So she would get to offset. So her AGI, 10% of her AGI this year would be 11,000. 10% of her AGI in 2024 would be 20,000. So you can see she gets a lot greater deduction if she does it that way and amends her tax return. She loses quite a bit of deduction. So we file it on this, and these are all personal losses, not business losses. So if it's a business, that goes in a different place. But for these casualty losses, so the form to fill out is 4684. All of the individual types of property are listed here, along with, so date acquired for those items, and then all of this calculation is done for each column. So for the furniture, it's everything in column A pertains to the furniture. Everything to the auto is column B, and then the personal residence is column C. All of those are done separately and then added together. That $100 is subtracted because this is one event. So even though it's 3 items, it's one event. So you only have to subtract it once. And then the calculation for the AGI, that 11,005. So all of this is represented there on the form. that is filed. Taxpayer has to be able to prove both the fact of the casualty or the theft and the amount of the loss. So probably get an insurance adjuster or some sort of substantiation there. Newspaper articles, photographs, and police reports are commonly used to document the fact of a casualty or theft. Well, you'd have to have that presidentially declared disaster area. What else do I want to say here? So you fill out that form, and then the amount, this $63.95, would get transferred to the Schedule A as a deduction. Any questions about that? So it's a deduction, but it's severely limited, obviously, by the fact that it has to be a presidentially declared disaster area, and then you've got to reduce it by the amount of insurance that you receive, and that $100, which isn't really a small deduction, but you got to reduce it by that, and then also only the amount then over 10% of your AGI would be included as the deductible loss. This is a very short section, so I'm just going to keep going here. So other itemized deductions, gambling losses are deductible. So if you go to the casino and you spend $600 and you win $12,000, you can deduct the $600 that you spent to offset the $12,000 as long as you itemize your deductions, right? But it is limited to the amount of winnings. So if you go to the casino and you spend $600, you lose $600 in that, and you win $500, you are limited to $500 deduction. You can only take the loss up to the amount of winnings. Those gambling winnings are usually reported on a W-2G form, and it's only the amounts, I think, over $600 you would receive that W-2G, but you're still, even if you win and you don't get a form, a reporting form, you're still supposed to claim that. But that big limit is the up to, again, it's only up to the amount of winnings. So you can't just go out to the casino, spend a whole bunch of money, and you really have bad luck. You don't win anything. If you don't win anything, you don't get to deduct anything. Did you? Yeah.
Well, it doesn't even matter. So say I spent $195,000 so I got $95,000 if I got that.
Yes. Yes, so you could deduct up to the $95,000, what your winnings are, and it would be your total, like your total loss. So let's reverse it and say you won $100,000 and you spent $95,000. That $95,000 can include all of the lottery tickets that you purchased during the year, all of the times that you went to the casino. It's not. It doesn't have to be a one for one. Like I won $100,000. How much did I spend today? No, it can be over the course of the year. Yeah. Okay. Casualty losses from income-producing property, they go on a different form. So if it's, like I said, it's business property, that goes on a different form. So that's all we really need to say there. Those are the only other items. There used to be a bunch of different itemized deductions that you could take. Like you could, if you were a W-2 employee and you spent money on your money that you didn't get reimbursed, like say your personal car, you used your personal car to go to business meetings and stuff like that, and you never got reimbursed for mileage. It used to be you could deduct that mileage. You can't do that anymore. It was under other miscellaneous deductions, but that was taken away as well. So, any questions?